Today's quick review is all about subsequent events, one of those topics that seems straightforward until the CPA exam starts changing the dates and asking whether to adjust the financial statements or simply disclose the event. Instead of memorizing examples, I want you to think through a simple decision process. Every subsequent event question can be answered by asking yourself the same question every single time. First, let's understand what a subsequent event actually is. A subsequent event is an event that occurs after the balance sheet date, but before the financial statements are issued, or for private companies, before they are available to be issued. During this evaluation period, management must determine whether any events occurring after year-end require an adjustment to the financial statements or simply disclosure in the notes. As soon as you see a subsequent event question, immediately picture a timeline. There are 3 important dates you should identify. The first is the balance sheet date. The second is the date the financial statements are issued, or for private companies, the date they are available to be issued. The third is the date the event actually occurred. Every question revolves around comparing these 3 dates. Now remember that every subsequent event falls into one of only 2 categories. It is either a recognized subsequent event, which means you adjust the financial statements, or it is a non-recognized subsequent event, which means you disclose the event only if necessary. The easiest way to determine which category applies is by asking one simple question. Did the condition already exist at the balance sheet date? If the answer is yes, then the event is recognized because it provides additional evidence about a condition that already existed. If the answer is no, then the event is non-recognized because it represents a completely new condition that arose after year-end. Let's start with recognized subsequent events. These require an adjustment to the financial statements because the later event simply confirms information about an existing condition. I like to think of recognized events as situations where the problem already existed, but management simply didn't know the full extent of it yet. The later event provides more evidence about something that was already there. For example, suppose a lawsuit is settled shortly after year-end. Ask yourself whether the lawsuit existed at the balance sheet date. The answer is yes. The settlement simply confirms the amount of the liability that already existed, so the financial statements must be adjusted. Another common example is a customer filing bankruptcy shortly after year-end because they were already experiencing financial difficulties before year-end. The bankruptcy confirms that the receivable was not collectible, so bad debt expense should be adjusted. Another example is discovering that inventory was obsolete shortly after year-end. The inventory didn't suddenly become obsolete after year-end. It was already obsolete. Management simply discovered it later. Since the condition already existed, the inventory balance should be adjusted. Notice the pattern. Nothing new happened. The later event simply confirmed information about an existing condition. Whenever you catch yourself thinking, "This just gives us more information about something that already existed," you are almost certainly dealing with a recognized subsequent event, and the financial statements should be adjusted. Now let's switch to non-recognized subsequent events. These are actually much easier because the condition did not exist at the balance sheet date. Since the event represents something entirely new, the prior year's financial statements are not adjusted. Instead, the event is disclosed in the notes if the information is material enough that users should know about it. Think about a fire that destroys a building after year-end. Did the building burn down on the balance sheet date? No. The fire occurred afterward, creating a brand new condition. Since nothing existed at year-end, the financial statements are not adjusted. Instead, the company simply discloses the event if necessary. The same rule applies to floods, hurricanes, tornadoes, or any other natural disasters that occur after year-end. These are new events, so disclosure is appropriate, but no adjustment is made. The same concept applies when a company issues debt after year-end. That debt did not exist on the balance sheet date, so there is nothing to adjust. The company simply discloses the issuance if necessary. Issuing stock after year-end follows the same rule. Since the shares did not exist at year-end, the event is disclosed but not recognized. Business acquisitions occurring after year-end are also non-recognized subsequent events because the acquisition represents a brand new transaction that occurred after the reporting date. The easiest way to remember this chapter is by thinking about old conditions versus new conditions. Old conditions require adjustments because they already existed at year-end. New conditions require disclosure only because they did not exist on the balance sheet date. Whenever you're answering a CPA exam question, pause before looking at the answer choices and ask yourself one simple question. Did the problem already exist at year-end? If the answer is yes, adjust. If the answer is no, disclose only. Now let's discuss the subsequent event evaluation period because the exam loves testing this distinction. For private companies, management evaluates subsequent events beginning with the balance sheet date and continuing through the date the financial statements are available to be issued. Think of this as the point when the financial statements are complete, finalized, and approved for release. They do not actually have to be distributed yet. For public companies that file with the SEC, the evaluation period continues through the date the financial statements are actually issued to users. Public companies evaluate through the issuance date, while private companies evaluate through the available to be issued date. Once the evaluation period ends, any events occurring afterward are ignored for subsequent event reporting purposes. One final topic that students often confuse is the difference between reissuance and revision of financial statements. Although the words sound similar, the accounting treatment is very different. Reissuance usually occurs because of an error correction or a retrospective accounting change. Whenever financial statements are reissued, the evaluation period resets. Think of someone pressing a reset button. Management must go back and evaluate subsequent events again through the new reissuance date. Reissuance resets the clock. Revisions are different. A revision is generally used to correct an immaterial error. Unlike reissuance, a revision does not reset the evaluation period. The original issuance date remains the cutoff, and management does not reevaluate subsequent events. The original evaluation period remains in place. No reset occurs. Let's finish with one final review. Recognized subsequent events involve old conditions that already existed at the balance sheet date, so the financial statements are adjusted. Common examples include settlement of lawsuits confirming existing liabilities, bankruptcy of a customer with pre-existing financial problems, and discovery of inventory obsolescence that already existed at year-end. Non-recognized subsequent events involve new conditions that occurred after year-end, so they are disclosed only. Examples include fires, floods, natural disasters, issuance of debt, issuance of stock, and business acquisitions occurring after year-end. Remember the three important dates: the balance sheet date, the financial statement issuance date, or available to be issued date, and the event date. Private companies evaluate subsequent events through the available to be issued date, while public companies evaluate through the issuance date. Reissuance resets the evaluation period and requires management to evaluate subsequent events again, while revisions do not reset the clock and do not require reevaluation. Finally, if you remember only one thing from this entire chapter, let it be this question: did the condition already exist at the balance sheet date? If the answer is yes, adjust the financial statements. If the answer is no, disclose the event only if necessary. Good luck, and let's keep moving one step closer to earning those 3 letters after your name.